Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at AXT.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so getting back to that missing concrete on the AI superhighway, we really need to take a step back with the momentum we are tracking right now on AXT.
Yeah, definitely, because they're emerging as the absolute bottleneck of the entire optical build-out.
Right. I mean, we're looking at a stock that is up roughly, 590 to 603% year to date?
Exactly. And when you compare that to the broader industry growth, which is hovering around just 35 to 40%, I mean, AXT is completely breaking the scale.
It's wild. The market is just violently waking up to the reality of these physical limitations.
Yeah, for the last year or so, everyone was entirely focused on the intelligence layer, right? Like the massive GPU cluster.
Sure, the software side of things.
Exactly. But to really understand this massive 600% price action, you have to look at the physical hardware. AXT manufactures indium phosphide substrates.
Which the industry just calls NNP, right?
Right, NMP.
So let's break down why that specific material actually matters for the listener. Because if a company like NVIDIA creates the brain of the AI with their processors, indium phosphide is, it's essentially the optic nerve.
That's a great way to put it.
Yeah, you can build the most powerful digital brain in human history, but if the optic nerve is severed, that brain is paralyzed. It's stuck in a dark room.
Well, traditional copper wires are just way too slow now, and they generate way too much heat for these new data centers.
It's like trying to send a handwritten letter when you really need a text message. The only way thousands of processors can share data fast enough is by communicating with literal lasers at the speed of light.
And silicon, for all its processing power, it is terrible at emitting light. You physically need these indium phosphide crystals to generate and detect those high-speed laser signals.
And you just cannot code your way around that limitation. Software engineers can't optimize away the need for raw crystal substrates.
No, they can't. And because this material is an absolute prerequisite for building high-speed optical interconnects, it presents this fascinating dilemma.
Right, which brings up the core question for today. When you discover the physical bottleneck of a multi-trillion-dollar supercycle, is it still worth risking your capital when the stock is already trading at all-time highs?
All right, let's move into the wealth-building context. If we want to look beyond just the immediate blistering price action, we really need to examine the overarching portfolio strategy.
Yeah, because we're witnessing a massive structural capital rotation right now.
Exactly. The early money was made buying the pure processor designers. But that specific trade is, it's maturing.
Institutional capital is migrating down the supply chain now. They're hunting for the next layer of infrastructure, which is known as photonics. We're moving from computing to connectivity.
And playing the connectivity angle requires a totally different framework. To build a multi-year portfolio here, you need exposure to companies that are completely insulated from software disruption.
Right, because a new startup can write a better algorithm overnight. But nobody can just spin up a massive crystal manufacturing facility overnight.
No, definitely not. It's the ultimate evolution of the picks and shovels strategy.
Everyone knows that old rule from the gold rush. Don't buy the gold miners, buy the companies selling the pickaxes.
Yeah.
But we need to upgrade that analogy for the modern AI era.
Yeah, how so?
Well, NVIDIA is selling the standardized pickaxes, sure, but AXT owns the only forge capable of smelting the highly specialized heat-resistant steel required to make the handles.
Oh, I see.
And if you control the only forge in town, you dictate the pace of the entire gold rush. If hyperscalers can't source indium phosphide, they just can't physically connect their GPU clusters.
Now let's look at the fundamentals.
Well,
Because owning the only forge sounds great in a narrative, but we need to see if that narrative is translating into actual cash flow.
absolutely. We need to examine their order book.
Right. And the hard financial data is showing explosive velocity. First quarter 2026 revenue came in at $26.9 million.
Wow, that's a massive sequential and year-over-year jump, isn't it? From
Right.
what, $19.4 million last year?
Yes, exactly. But the breakdown of that revenue is the true indicator of where the demand is coming from.
Okay, let's hear it.
Specifically, the revenue generated purely from indium phosphide substrates surged to $13.6 million. That single material now accounts for over 50% of their total quarterly revenue.
That's incredible. Wasn't that number just like $3.8 million 12 months ago?
Yeah, a mere $3.8 million. And that demand is feeding directly into a record $100 million backlog, which is up from $60 million in late 2025.
And alongside that top line growth, they're pushing their adjusted gross margins up to nearly 30%, right? 29.9% to be exact.
Right, up from 21.5% in the previous quarter.
Yeah.
But we should pause on how they're actually doing this because their manufacturing mode is deeply scientific.
Yeah, they operate in a very tight oligopoly. AXT is one of basically 3 companies controlling 80 to 90% of the entire global supply of indium phosphide.
And their edge comes down to something called a vertical gradient freeze furnace, or VGF.
So how does that actually work?
Well, the VGF process is notoriously difficult to master. Think of it like trying to freeze a perfectly flawless, crystal clear block of ice.
Okay, I follow.
If you drop the temperature too fast, the water freezes unevenly, right? It traps air bubbles and creates these cloudy microfractures.
And if you try to make lasers out of a fractured crystal, the light just scatters and the component fails.
Exactly. AXT's proprietary furnaces slowly and meticulously cool the raw liquid metals from the bottom up. It forces the atoms to align perfectly, layer by layer.
So competitors who try to rush this just end up with high defect rates, which destroys their profit margins.
You nailed it.
Okay, I hear the argument on the technological moat and the massive backlog, but I am going to push back hard on the state of their balance sheet.
Okay, go ahead.
Because building these specialized furnaces is incredibly capital intensive, and current shareholders are paying a steep price for it. They recently executed a staggering capital raise of $632.5 million.
Yeah, that was a significant move.
The most painful part is the $550 million they raised by dumping 8.56 million new shares onto the market at $64.25 a share. That is severe punishing dilution.
It is.
So how do you justify watering down the equity pool that aggressively?
Well, dilution is an incredibly bitter pill, and it's a very fair critique of management's timing. However, the capital is not being used to just keep the lights on or pay off bad debt.
Where is it going then?
It's strictly earmarked for their Beijing Tongmei subsidiary to execute a massive multi-year physical capacity expansion.
I see, so it's about scaling up.
Right. In a hardware oligopoly, when demand goes vertical, the player who scales their physical footprint the fastest permanently captures the market share. They're trading current equity dilution for future monopoly power.
Because they see the $100 million backlog, they know the hyperscalers are desperate, and they just physically need the floor space to deliver the crystals.
Exactly.
That brings us to the catalyst timeline.
Yeah.
If they're scaling up for total dominance in 2027 and beyond, what are the immediate events that could move the needle in the next 3 to 6 months?
The closest major catalyst is their upcoming Q2 2026 earnings report, which we expect in late July or August.
And management has laid down some aggressive guidance there, right? Projecting record revenue of at least $34 million.
Yeah. But the true psychological trigger for Wall Street is that this is projected to be their first genuinely profitable quarter, with guided adjusted earnings per share sitting between 6 and 8 cents.
And crossing that threshold from a cash-burning growth story into actual profitability is what unlocks the heavy institutional buying.
Exactly. Many large mutual funds and pension funds have strict mandates that prevent them from investing in companies without positive earnings.
Is there anything else structurally driving the price?
There is a broader structural catalyst, yeah. We are tracking a wave of new, specialized photonics ETFs preparing to hit the market.
So that introduces forced passive inflows. When these thematic funds launch, their algorithms automatically purchase the underlying assets.
Right. And because AXT is a pure-play supplier in optical connectivity, they're sitting directly in the crosshairs of that incoming capital.
Those are the highly visible near-term events. But the speculative catalysts are where the real asymmetric upside lies, right? Like the Chinese star market listing.
Yes, AXT is actively pursuing a domestic listing for their Tongmei subsidiary on the star market, which is essentially China's equivalent of the NASDAQ.
And pulling that off would unlock a massive amount of hidden value. Tech hardware companies listed domestically in China often command much higher valuation multiples than Chinese assets listed on U.S. exchanges.
Exactly. It gives them a premium currency to fund local expansion without further diluting the U.S. parent company's stock.
But the most critical catalyst, the one that defines their future, is this R&D race to qualify 6-inch indium phosphide wafers with major hyperscalers like Google, Meta, and Microsoft.
Right, because currently the entire industry standard is built on 4-inch wafers.
So why does the jump to 6-inch matter so much?
To understand why it matters, you really have to look at the geometry. The area of a circle grows exponentially with its radius. Moving from a 4-inch to a 6-inch crystal doesn't just give you a little more material.
It more than doubles the usable surface area, right?
Yes, and it drastically reduces the wasted space at the edges of the wafer. For hyperscalers manufacturing these optical transceivers, it exponentially drops their cost per chip.
But growing a 6-inch crystal without it collapsing under its own thermal stress is just a metallurgical nightmare?
It really is. But if AXT is the first to crack that code, stabilize the atomic structure, and get it fully qualified by big tech, they effectively leave their competitors in the dust.
Now let's pivot to the chart.
Yes, because the technical structure is telling a fascinating story about how the broader market is absorbing all this data.
We're seeing extreme, almost violent, bullish price action.
Definitely. Recently, the stock posted consecutive daily surges of 15% and 16%, blowing past all historical resistance levels to reach a record high of $140.83.
The sheer velocity of that move indicates a total fundamental shift in perception. The market is no longer treating AXT as a legacy semiconductor company.
No, it's completely repricing the asset as a pure-play, physical AI scarcity stock.
And the most revealing technical detail goes back to how the market handled that massive dilution event we talked about earlier.
I'm glad you brought that up because structurally, that is the defining metric of this run.
Usually when a company dumps 8.5 million new shares onto the open market, the sheer weight of that supply crushes the stock price.
Exactly. But here, they offered those shares at $64.25. The market completely absorbed that massive $550 million block of equity, barely flinched, and then the stock proceeded to more than double.
It rocketed past $140. That specific volume absorption is the ultimate hallmark of institutional desperation.
It really proves mathematically that the demand from large funds looking to secure a position vastly outstrips the massive new supply of shares. They just ate the dilution and kept bidding the price higher.
So what does market sentiment look like? I mean, we can clearly see the aggressive flow of capital, but what's the narrative?
The prevailing narrative gripping the market right now revolves around a single word: unobtainium.
Unobtainium, that's quite the label.
Yeah. Retail investors and thematic fund managers are swarming the asset because they view indium phosphide as the ultimate choke point.
It's getting swept up in a massive wave of FOMO, fear of missing out, as capital frantically searches for the physical, irreplaceable components of this build-out.
Right. But we have to look at the flip side, too.
Yeah, I have to introduce a stark dose of skepticism here. Because there is a glaring, massive divergence between this retail FOMO and the professionals modeling the cash flows.
The Wall Street analysts.
Exactly. They are completely disconnected from the current price action. While the market is gleefully paying around $140 a share, the average one-year analyst price target is anchored way down between $87.75 and $89.50.
It's a stunning disconnect. You rarely see price targets lag actual trading prices by $50 in a multi-billion-dollar company.
It forces any rational investor to ask, are the traditional Wall Street analysts just painfully slow to update their models for the supercycle? Or has the broader market completely lost its mind and abandoned all valuation metrics?
Now let's talk about the risks. Because you cannot analyze a chart that goes vertical by 600% without acknowledging the severe gravity of the downside.
Yeah, we have to lay out the bear case heavily here. When a stock runs this hot, the margin of safety disappears entirely.
Let's start with the valuation risk.
At these levels, the stock is trading at a staggering 187.3 times forward price to earnings. To put that in perspective for a hardware company, you're paying $187 today for every $1 of profit they might generate next year.
The market isn't pricing in their current reality. It's pricing in absolute, flawless, multi-year perfection. If they stumble even slightly, that multiple will compress violently.
Which is exactly why it currently carries a Zacks value score of F. Traditional metrics scream that it's wildly overbought.
And when a stock is priced for perfection, the actions of the insiders become the most important signal in the room.
Oh, this is the major red flag that cannot be ignored. Over the last 90 days, corporate insiders have sold $43.27 million worth of stock. Zero insider purchases.
And specifically, the CEO and the CFO dumped $31.6 million worth of their own shares in early March.
The timing of those sales is so critical. They were unloading those shares at prices between $36 and $51.
Which is miles below where the stock is trading today.
Consider the psychology there. If the chief executive and the chief financial officer, the two people looking at the internal order books every single day, didn't foresee the intrinsic value hitting $140, why should an everyday investor risk their own capital buying at these levels?
The optics of that insider selling are terrible, and it creates a massive psychological hurdle. But the risks don't stop at valuation. You also have geopolitical risk.
Right. Almost all of AXT's raw manufacturing capability is heavily concentrated in China, and indium phosphide is a critical mineral subject to very strict Chinese export controls.
Beijing has been tightening their licensing rules around strategic tech materials.
If those export permits get delayed or politicized as leverage in trade wars, AXT could be entirely cut off from their U.S. hyperscaler clients.
The export risk is a genuine threat. However, there are robust structural counterarguments to that bear case.
Like what?
Well, regarding the geopolitical chokehold, the mitigation strategy is actually built into the Chinese economy itself. Domestic demand within China for indium phosphide is exploding.
As they build out their own sovereign AI infrastructure.
Exactly. Internal demand is expected to make up 30 to 40% of the entire global market by the fourth quarter of 2026. AXT can sell locally within China, bypass the U.S. export permit bottlenecks entirely, and still capture massive revenue growth.
So with everything on the table, what's the final verdict?
Based on the synthesis of the financial models, the structural supply chain data, and the risk profiles, the underlying research assigns AXT an official bullish score of 7 out of 10.
A 7 out of 10. Okay.
Yeah. The thesis really requires a long-term lens. Yes, you are contending with extreme valuations, and the insider selling near the $40 mark is a difficult pill to swallow. But the structural scarcity of indium phosphide, combined with AXT's proprietary VGF intellectual property moat, justifies a premium during this phase of the cycle.
So it's not a short-term momentum play.
No, the strategic play here is viewing this as a multi-year hold to capture the massive capacity doubling slated for 2027. It's about positioning for the upcoming industry shift toward co-packaged optics, where lasers are mounted directly onto the silicon processors.
Which will demand even higher volumes of flawless crystals. A 7 out of 10 rating acknowledges the massive upside, but I will leave you with a final word of caution regarding the reality of hardware execution.
What's that?
Well, trying to justify a multi-billion-dollar market cap on a company currently generating roughly $100 million in trailing revenue leaves zero room for error.
That's a very fair point.
But it also presents a fascinating shift in how we understand technological leverage. We spend all our time obsessing over the software wizards in Silicon Valley, assuming they control the future of artificial intelligence.
But the takeaway here is a fundamental lesson in supply chain gravity.
Exactly. The entire AI revolution and the trillion-dollar ambitions of the biggest tech companies on Earth currently hinges on a handful of specialized furnaces in Beijing slowly melting metals at 1,000 degrees. That is the real choke point of the 21st century. If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.